For over 80 years, the federal income tax system has been a pay-as-you-go system. Rather than pay your entire tax liability when you file your taxes, you pay your tax throughout the year, usually through tax withheld at the income source. That's fine if your income is subject to withholding, such as wages or pensions, but how do you pay as you go when your income is not subject to withholding, such as business or investment income? That's what today's video is all about. I'm the Tax Geek, and here are estimated payments, oversimplified. In order to avoid penalties for not paying your income taxes throughout the year, you must prepay either 100% of the previous year's tax liability or 90% of the current year's tax liability, whichever is lower. And what's more, prepayments must be made evenly throughout the year. So if you anticipate a large tax liability and pay 95% of it in December, you may still find yourself paying an underpayment penalty when you actually file your taxes. If your income is mostly from sources that are not subject to withholding, making quarterly estimated payments can avoid the penalties associated with having a large balance due. Estimated payments are due in mid-April, mid-June, mid-September, and mid-January of the subsequent year. For 2023, the estimated payment dates are April 18th, 2023, June 15th, 2023, September 15th, 2023, and January 16th, 2024. Making the payments themselves is pretty easy. You can make payments by check or money order accompanied by a Form 1040-ES, or you can go online and make a payment directly out of your bank account. To do that, go to www.irs.gov and choose Make a Payment. Choose Estimated Tax as a reason for payment and follow the further instructions on the screens. If you do make a payment by check or money order, make sure your Social Security number, the words 1040-ES, and the tax year are written on it. The hardest part of this whole process is figuring out the estimates. There are guides for calculating estimated payments given in the instructions for Form 1040-ES. A detailed look at the estimating process will be covered in an upcoming video. Many taxpayers base their estimated payments on their prior year's return and their current year's financial records. Let's see how this works using Walter. He is a self-employed contractor. Looking at his prior year income as well as his business records for the first part of the current year, Walter estimates he should net $42,000 this year from his business. How Walter computes his estimated tax is shown on the screen. To learn more about these calculations, there are links to videos explaining how taxes are computed for the self-employed in a card above or the video description. These calculations result in a total estimated tax for the year of $8,160. This figure is divided by 4 and rounded up to the next $100 to arrive at his estimated payment amounts. If you're making estimated payments, it's a good idea each quarter to re-evaluate your estimate and make adjustments as needed. You don't have to make the same payment each quarter as long as your estimate reflects your anticipated income at the time of payment. In Walter's case, if he re-examines his books in September and finds his estimated net income has risen to $65,000, he can repeat the calculations he did before to revise his estimated tax liability. He subtracts the payments he's already made and divides the result by 2 to come up with the September and January estimated payments. If you find yourself needing to make estimated payments, there is an easier way available to many people. If, in addition to the income not subject to withholding, you have income that is subject to withholding, you can have the withholding on that income increased and possibly eliminate the need to make estimated payments altogether. One way to do this is by estimating the amount of additional income and entering that amount on line 4A of your W-4. This works well for additional investment income, but less well for self-employment income because this method doesn't account for self-employment tax. In this case, you can estimate the actual taxes on the additional income using the same method as when making estimated payments. The estimated taxes are then divided by the number of pay periods per year, and the result is put on line 4C of your W-4. In Walter's case, if he had an additional job that paid him as an employee, he could have an additional $310 deducted from each biweekly paycheck instead of making estimated payments. Fred is an IT professional. In addition to his regular $92,000 salary, he estimates he'll have an additional $7,500 from his investments and $3,700 in income from his grandfather's trust fund. Rather than make estimated payments, he enters $11,200 in additional income on line 4A of his W-4. Fred's employer would take the additional income into account when calculating his withholding. This saves him the effort of estimating the actual taxes on the additional income. Paying the taxes on your additional income via withholding has a number of advantages. First of all, it's automatic. You don't have to remember to make the estimated payments. Next, you might find that paying the additional estimated taxes over many pay periods is easier than making larger quarterly tax payments. Taxes paid through withholding are always assumed to have been made evenly, so you avoid any penalty for not paying evenly throughout the year. And finally, you don't have to keep track of the payments you've already made. The estimated taxes on the additional income are reported in Box 2 of your W-2. If you've made estimated payments, you need to track the payments you made and remember to enter them on line 26 of Form 1040 when it's time to file your return. The IRS will not send you a reminder that you made the payments, but you can view your payments by signing on to your IRS online account. If the state you live in has a state income tax, you may also have to make estimated payments to the state or alter your state withholding. All states that have income taxes have a procedure for making estimated payments, and most give taxpayers the opportunity to enter additional withholding on their state withholding forms. In short, making estimated payments can help you avoid a large balance due when you file your taxes, as well as avoid penalties for not paying as you go. You'll find additional information on calculating and making estimated payments linked in the video description. Please like the video if you found it informative and share it with anyone else who would find it useful. Subscribe if you haven't already for additional oversimplifications of our complex tax system. And of course, your questions, comments, and suggestions are always welcome in the comment space below. Thanks for watching, and I'll be back soon with more of Your Taxes Oversimplified.